A nice start, 2-1, advancing the declining stocks. This is despite the weakness in the FANG names. Look at the sectors here. We've got a great start for energy. I mean, all the big oils up 2-3%. Industrials okay. Healthcare, modest leadership. And there's a weakness in tech and consumer discretionary, but that's largely because of the FANG names. I just want to point out what a great start oil's got today. Oil's up modestly 60 cents or so, but all the big oil names, big oil like Chevron, Total, PetroChina, everything's up 2 or 3%. You got other names like Apache, Concho, those are big in the Permian, EOG, that's big in the Bakken. All the stuff, all up 1, 2, 3%. The antitrust headers from President Trump about Amazon, Facebook, Google, they're all weighing on the FANG names. Apple's weak as well, as you can see, down about 2% here. Elsewhere, over the weekend, nothing I saw changed my opinion about what really matters for the market, and those are two things. Number one is China trade and tariffs, and it seems to me, and I haven't changed it over the weekend, the best case here would be some kind of truce rather than a deal. That's what everybody was talking about. Maybe we don't get 25% tariffs going in. Maybe we just still get negotiations, but it's just sort of a truce. The other issue is rising rates and the 10-year yield. And again, the best case here seems the Fed is very sensitive. We do get a rate hike in December, but there's some indication if there is slower growth, the Fed will respond to that. This is the bull case scenario. The other thing that you need to watch a little carefully here is the revenue situation. There is some signs that margin pressures are starting to weigh a little. So Q3, we had 8.5%, good numbers, but the number of companies beating was slower than anticipated. That's a surprise. Q4 numbers are still good in Q1 in 2019, but they've come down a little bit in the last few weeks. And again, I think these are some signs that we're seeing out there of margin pressure. Keep an eye on that. The buyback story continues. I know everybody made a big deal. Berkshire back $900 million in stock. That's very nice. Apple had its 10K out over the weekend. They bought back $19.5 billion, 20 times what Berkshire bought back. And I keep emphasizing how important the buybacks are, not just for Apple, but for everybody. So remember, Apple authorized a $100 billion buyback program on May 1st. So far, they have spent $29 billion. Apple has $71 billion in authorized buybacks they have not spent that can be spent to buy back their stock. That's very, very important. And I've been pointing out corporate America is the marginal buyer of stock, and not just for Apple, not so much the ETFs. Yes, there's money going into ETFs, but that's money coming out of mutual funds by and large. Who's the marginal new buyer of stock for the last several years? It has been corporate America. We expect to have $1 trillion in buybacks announced this year by the end of the year. That will be an all-time record far and away. And no, a lot of it is not used yet. One firm estimated $350 billion is dry powder. That's unspent. That's why I'm saying that it's not just Apple. There are over 300 companies in the S&P that have active buyback programs. And those companies, seeing the prices down as they have been down, I think are going to help support the market in the fourth quarter. That's the important thing from here right now. Dow's up 77 points. Carl, back to you.